Hey everyone, welcome to the lecture that we're going to be doing on property, plant and equipment, where we'll be covering selling and depreciation. So as you can see here, I've created a list of topics that you will need to study for your upcoming test. So we'll be covering the main depreciation types, straight line, declining balance, and units of production. And then we'll check what are the journal entries involved when it comes to selling property, plant and equipment. So let's do that through a question. The very first thing I'll do is the journal entries for selling for property, plant and equipment, and then we'll see how depreciation questions work. So this is a fairly simple question. It tells us that the company purchased some equipment. The original cost of the equipment was 120,000. It had a residual value of 20,000, and we estimated it could last 4 years. After this, the equipment was finally sold for 75,000. We need to know what are the journal entries involved, the company uses, and let's assume that they're using straight line method. So let's get started. So for a lot of these questions, they may require you to, they may ask you to, first of all, make the journal entries regarding the purchase. So when you would have purchased the equipment, your journal entries involved would have been a debit to equipment and a credit to, say, cash or accounts payable or some other kind of thing, right? Then let's see what the depreciation schedule looks like. So we have the original cost, 120,000. We have the residual value, which is 20,000. And we have the lifetime, which is 4 years. Using straight line method, we can find out what the annual depreciation is. So annual depreciation straight line is equal to cost minus RV divided by lifetime, right? So that gives us 100,000 divided by 4, which is 25,000. So that means for each of the 4 years, we'll be removing 25,000 from the equipment value, which means we'll be putting 25,000 in accumulated depreciation. So for each of the years, this is what the journal entries would look like, right? We'll debit depreciation expense and credit accumulated depreciation, right? 25,000. And we'll be doing the same exact thing for each year. So each of the 4 years, we'll be doing this, which means at the end of the 4 years, the total depreciation will be 4 times this, which is 100,000, right? So now at this point, this is when we are selling the equipment. So let's go ahead and do that. So when it comes to selling of equipment, there'll be 4 journal entries involved. The very first one, you'll be debiting cash because we'll be receiving cash for the equipment. Next, we'll be debiting accumulated depreciation. So all these years, as you can see here, we were crediting accumulated depreciation, right? We were storing that value in there. But now that we are selling it, let us remove that value there by reversing it. So in this case, we'll be debiting accumulated depreciation. So we debit accumulated depreciation and we have a credit, which is the equipment, since we're giving away the equipment, that. And now, depending on whether you're making a profit or a loss after the sale, depending on how much cash you're getting for it, you'll either have a debit for loss on sale of equipment, or you'll have a credit on gain of sale. So that'll pretty much depend upon whether you're making a loss or gain. So let's go ahead and write the journal entries for this. The journal entries will be a debit for cash. They've told us how much cash we received, 75,000. So let's go ahead and put that. Next, we have to debit the accumulated depreciation. How much? 100,000. Because 25,000, we were doing that for each year. We've recorded for 4 years. So that's 100,000. So let's do that. Also, we need to credit equipment. Which is the original cost of the equipment. So that's 120,000. Now at this point, we either need to add a gain on sale of equipment or loss on sale of equipment. Now the way that I like to do this is that for journal entries, we all know that the debits always have to equal the credits. But here we can see that the debits add up to 175, but the credits only add up to 120, which means there's a missing credit value here, right? So we can just add that credit in. That credit will be the difference between these two, right? So that will be 55,000. So there's a missing credit of 65,000. Now the point is, what account are you going to use here? So since it's a credit, you remember that losses are debited and gains are always credited. Gains are like sales. So like anytime we make revenue, we always credit it. And anytime we have expenses, which are like losses, we debit them, right? So since there's a missing credit here, we automatically know that it's a gain on sale. And we can put in a gain on sale of equipment as the missing value. And now all of these are your journal entries associated with selling the equipment. There's another way you can do this, which is you calculate the net book value at time of sale. So what the net book value basically is the original cost minus how much of a depreciation you recorded so far. So the original cost was 120,000. From that, we subtract how much of a depreciation we've accumulated, which is 100,000. That gives us a net book value of 20,000. So basically, on our books, the equipment's worth 20,000, but we received $75,000 as cash for it, right? Which means we received a lot more than what it was worth, which automatically tells you that we made a gain. So that's obviously a gain on sale. And that'll be the difference of these two, which is again 55,000. And then you can go ahead and write the journal entries. So there are effectively two ways to do this. You can choose either which way. They'll both give you the correct answer. I prefer doing it the way using the journal entries because I find it much more intuitive. And then I don't need to remember what the hell a net book value is. So I find this much easier. Yeah. So now that we know how to do that, let's see the different depreciation methods. The first one is the straight line method. This is the one we've been dealing with the most in class, so I'm sure everyone's comfortable with that. The next one is the declining balance method. This one uses a percent, and each year we reduce the net book value by how much ever the depreciation percent is. So let's say it's 30%. So each year we'll reduce the next net book value by 30%. And we'll do that for each of the years to get to the depreciation expense. So imagine if let's take an easier value, 100,000. 100,000 is the value that we start with. Then this is the cost. And let's say we're going to use a 30% depreciation rate. Then at the end of the first year, our annual depreciation will be equal to 30% of this. So let's see how much that is. 0.32, which is 30,000. So after the first year, the value of this has gone down by 30,000. So let's find the net book value. So net book value after that is 100,000 minus 30,000, which leaves a value of 70,000. Now for year two, solve year one. This is year two. Now year two, we start at 70,000 as a net book value. Now again, let's multiply that by 30%. That gives us an annual depreciation of 70,000 times 0.3, which gives us 221,000. So now that we have that, we again find the net book value. So for year three, our net book value will be equal to 70,000 minus this much amount, which is 49,000. And you keep doing that until finally you sell the equipment. So that is how we do this part. Okay. Now the next one is the methods, the units of production method. This, similar to straight line method, takes into account residual value. Remember, declining balance does not care about the residual value. We only care about the net book value, which is for each of the years, it will be the original cost of the equipment minus how much our depreciation how much the equipment has depreciated by so far. So when it comes to methods of production, units of production, you take the cost, subtract from it the residual value, and then you multiply this by a proportion. The proportion will be how much ever total it can either use up or it can produce in a year, divided by its total units over the course of its life. So let's say the question tells us that this thing is a machine. Okay, it's a machine of some kind in a factory, and this thing can produce 5,000 items, so some kind of object. So it makes 5,000 of these items over the course of its entire life. But so far this year, it has made 2,000 items. So now, for this question, then we'll multiply this by 2,000, divide by 5,000, and that will give us the annual depreciation for that year. So for units of production method for each of the years, we'll be determining how much the depreciation expense is based on how many units have either been used up or produced or whatever the particular peculiarities of that question are. So in case it's a vehicle, instead of how much it's produced, it could be how many kilometers it's traveled. So you assume that the vehicle can only travel 5,000 kilometers. And this year it's done 2,000 kilometers, then it's the same thing. Okay, so that's units of production. Now here's another topic that we'll have to deal with. What are we to do in case the estimates change? So let's say year one, year two, year three, year four, and year five. Let's say we bought a piece of equipment for $10,000. And we estimated that it'll last for 10 years. Let's forget about residual values now. So now the question tells us that each year we'll be depreciating it by straight line method. So each year we'll be depreciating it by $1,000. So and after this year, we'll subtract 1,000, 1,000, 1,000, and 1,000, right? So after that, this will keep going, of course, year 6, year 7, and on until year 10. But suddenly, we kept depreciating it each year for 1,000. And then when we reached year 5, we realized that, oh, the equipment actually isn't going to last us 10 years, that instead it's going to last us just 7 years. So on this date, it'll lose its value completely. So in that case, it changes the estimates, right? So far we've been depreciating by this amount and assuming that it would last 10 years, but now we assume it's only going to last for till 7 years in total. So in this case, what you do is we don't go back and retroactively change any of the past values. What we do is whenever the estimate changes on that particular date, we find out what the net book value is. So since we had a starting value of 10,000 and we've depreciated it 4 times by 1,000, that means that there's been $4,000 worth of depreciation. So now the value has gone down from 10,000 to $6,000, right? This is our net book value. This is currently how much our books tells us that equipment is worth. Now let's start from year 5 to year 7. That's 2 years. And now whenever we do depreciation, we'll depreciate this amount, assuming that this is the original cost of the equipment and that it's going to depreciate by this rate, which means now a depreciation will go up and will be 3,000, right? Because it's only going to last 2 years. So that's 6,000 divided by 2, which gives you an annual depreciation equal to 3,000. And then at the end of year 7, we'll sell it here. You may come across questions in the exam that tell you that the estimates change. If that ever happens, just remember, all you have to do is find the net book value whenever the reevaluation takes place. And after that, depreciate with the new schedule. But you have to check how much time is remaining since. So when you're depreciating it, ensure that you use 2 as the value and not 7. And that you'll be depreciating for just how much lifetime the item has left. Which is why if you look up here, the formula is actually expected life. So it's the life after the revaluation takes place. So that is how you solve these questions. They are again fairly easy. So you all should do well with these questions.